Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Matt Hougan, the Chief Investment Officer of Bitwise. So welcome to the podcast, Matt.
Thank you for having me, Bob. I'm delighted to be here.
It's a pleasure. So for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. Matt Hougan. I'm the Chief Investment Officer for Bitwise Asset Management. Bitwise is a specialist crypto asset manager. We're best known for having created the world's first crypto index fund, sort of the S&P 500 of crypto. We've been in the market for 4+ years, so through bull markets and bear markets, managing money mostly for financial advisors, family offices, and institutions. For what it's worth, I come from a traditional finance background. So before Bitwise, I was the CEO of ETF.com, built the first ETF rating system, largest ETF conference, some ETF media sites, ran that business for over a decade before selling it and then moving into crypto, the next big thing. So that's me in a 90-second nutshell.
All right. So you've spoken at numerous investments and wealth conferences to a packed house. Advisors are thirsting for information about crypto. Let's start here. Do you think Bitcoin or crypto will ever be used as a real currency?
Like as in the way you and I use our dollars?
Yeah.
In the US, it's going to be a long time to never, is my take. So, I'm the CIO of one of the world's largest asset managers. I've never bought coffee with Bitcoin. I still think it's a once in a generation technological breakthrough. I think it's going to transform how money, property, and finance works. But in terms of buying coffee, dollars work pretty well. Now, it may be in other nations that have less secure currencies, less stable currencies, they'll look to an apolitical alternative. I can imagine someone in Argentina buying lunch with Bitcoin. But I think it's going to be a while before we do it in the US. The dollar works pretty well for that. But the dollar doesn't work very well for moving money, for making finance more efficient, and for doing new and innovative things with property and money on the internet. The dollar is a analog technology, and we're living in a digital age.
So at the moment, we're in the midst of some volatile markets, and a question that always comes up is whether it can actually Bitcoin crypto be a store of value given the volatility that we're experiencing.
Yeah, absolutely. It's a store of value. I mean, if you look over the last 10 years, Bob, it's the best performing asset class in the world. In fact, over the last 3 years, despite the current volatility, it's the best performing asset class in the world. It's up over 200%. The way to think of it is to think of it as an emerging store of value. The analogy I like to make is to gold in the 70s. We talk about gold being 5,000 years old, but the modern history of gold starts in the early 70s when Nixon went off the gold standard. Before that, the gold was intimately tied with the US currency. After that, the world went through a period of figuring out what was gold's place in the world. And during that period, its place emerged as a non-sovereign store of value. In the 1970s, gold went up 1,300%, 600+% in real returns. Since 1980, its annualized return is less than 1%. The things about store of value is a store of value is not a great investment. A store of value, by definition, holds a fixed value over time. What we're trying to do when we invest is actually increase our wealth. And if you want to increase your wealth, you want to hold an emerging store of value, because as it emerges, you get that appreciation. That's what we've seen in Bitcoin over the last 10 years. And we'll continue to see that until it's as boring as gold. I note that during the 70s, gold was very volatile. There were years where it fell 30+%. It moved more than 3%, 1 out of every 3 days. It was Bitcoin-like. It's just we don't remember that because now gold is pretty boring. Bitcoin will be boring too. When my 8-year-old goes off to college, I bet Bitcoin will be as boring as gold. But I suspect that the price will be significantly higher because it will be established as a institutional store of value. It will have attracted all those assets. So yes, it's a store of value, but it's an emerging store of value. And that's actually a good thing as an investor.
Yeah. So you mentioned gold. Just a follow-up question. For many years, people thought of gold as an inflation hedge. and an uncorrelated asset.
Yeah.
What's your thought about, people have said the same about crypto, that maybe it's an uncorrelated asset and perhaps a hedge against inflation. Any thoughts about that?
Yeah. First of all, I actually think it's done a beautiful job about hedging against future inflation. If you think about the recent returns of crypto, the sort of modern inflationary acceleration started during the COVID pandemic, when we had a massive uptick in QE and a massive fiscal stimulus. And Bitcoin went from $5,000 at the start of COVID to $68,000 in November. What happened in November? November was the first time the Fed released notes from a meeting saying it was moving from quantitative easing to quantitative tightening. And what did Bitcoin do? It started trading down. It lost more than 50% of its value. During that COVID run-up, what Bitcoin was saying was that if we stay on this course, we're going to get not just 8% inflation, but runaway inflation. Once the Fed course corrected, Bitcoin said, well, inflation is not going to be as big a deal as we thought. I suspect that if we see the Fed course correct again and move into an easing environment, Bitcoin will rally substantially. People get confused because the CPI is a backward-looking number. You can't hedge a number that's reflecting what inflation was. It's already in the market. What an asset should do is protect against runaway inflation. And while it's a more complicated story, I think crypto has done that extremely well. Now, what is true is during risk-off periods, crypto is correlated with other assets. This has always been true in cryptos. I find people who are surprised with this confusing because everyone knows crypto is risky. If crypto being risky is a surprise to you, then you haven't been paying attention. So what happens to risky assets when we go into a risk-off environment is that they all trade down. I suspect, and the data supports this, if you look over 1, 2, 3-year periods, you'll still find low correlations to stocks. And I think that low correlation will return once we have a normalized macro environment, because the drivers of crypto are just different than the drivers of stocks. So the story that crypto is not an inflation hedge, and the story that it's not, it has high correlations to other assets, I think those are actually both false narratives. I think it's a fantastic hedge against future inflation. But what the market is telling you right now is that inflation is coming down. And so Bitcoin is coming down as well. If that reverses, Bitcoin will rebound the highest and the hardest of any asset out there.
So I've lost track of how many cryptos are out there, tokens, coins, whatever the term of art might be.
Yeah.
Do we need all those tokens, coins?
No, most of them are worth zero. They're 18,000 plus. Most of them will go to zero. The analogy I like to make is to software startups, right? Most of us use Microsoft and Oracle and Salesforce and a handful of household names, but there are 100,000 SaaS startups. They're all experimenting with software technology, trying to be the next Microsoft. The same thing is true in crypto. The only ones that matter really are the top 10 or top 20, but there are another 18,000 startups. 98% of those will go to zero, just like 98% of software startups will go to zero. But there's probably some good ideas in there, just like there are probably, major software companies that started last year that'll be household names. I mean, who had heard of Snowflake a couple of years ago? And now it's a household name, right? So I think the same thing is true here. Look, underneath every crypto asset, there's a blockchain. A blockchain is a piece of technology. It can be optimized to be good at different things. We're early in its development. People are taking lots of shots on goals on what you can do with the blockchain, what services you can provide. Again, most of them will go to zero, but some of them will be valuable. As an investor, that means you're probably best off just buying an index of the largest ones instead of trying to pick and choose winners. That's been a fool's game in stocks for 100 years. I suspect it's going to be a fool's game in crypto for the next 100 years.
Well, if I ever can figure out how to use a wallet, maybe I would own more of those 18,000, but thankfully I haven't figured out wallets yet. So speaking of figuring out things, there's a lot of fear on the part of investors and perhaps some advisors that crypto, Bitcoin is being used by criminals, or more recently during the Ukraine war by nefarious forces moving oil around, for instance, or buying oil. Any thoughts about that?
Yeah, I think we're always right to think about how new technologies can be used appropriately and inappropriately. And it's certainly true in the earliest days of crypto, in the sort of pre-regulated era of crypto, 2011, 2012, 2013. a high portion of the usage was in fact for illicit activity, things like Silk Road, buying drugs on the internet. That was true. The issue is people have anchored on that, and that's no longer true. Crypto is not very well. It has a robust regulatory framework around it. It needs to evolve, but certain things are really in place. AML KYC is pervasive in the mainstream crypto ecosystem. The ability to move money in Bitcoin in illicit transactions basically no longer exists. If you look at what happened in the Colonial Pipeline example, they asked for ransom payments in Bitcoin, and guess what? Those were seized a week later because the DOJ has evolved. It's now very sophisticated, and it can trace assets and seize assets. The DOJ's or the best statistics out there say about 0.15% of crypto activity is criminal related. That's way lower than cash. Cash, it's more than 5%. So that's no longer true. There are corners of crypto where it's true. Privacy coins, Bitwise won't hold privacy coins. Mainstream institutional investors won't hold them. Those are coins that can't have AML KYC applied to them. I suspect they'll be regulated out of existence. But mainstream crypto is not being used for criminal activity. It's actually being used less than cash because it's so traceable. Ukraine's a good example. Ukraine was a test case. In a heavy sanctions environment, would crypto institutions and brokerages cooperate with the government to ensure that crypto couldn't be used to negotiate around sanctions? And the answer to that was a resounding yes. All the mainstream institutions blocked access to sort of traditional Russian wallets. And we didn't see any activity that would suggest that Russia was using crypto rails to evade sanctions. It's still something we need to think about. As every technology comes, you need to ensure that it fits, that regulations allow it to exist in the way it should. But so far, the record is actually pretty clean.
So we've seen cross currents with various governments either adopting or banning or thinking about banning crypto. What's the outlook there for?
Yeah, I mean, China banned retail ownership of crypto assets. One of the greatest investing rules of all time is that anytime China bans something, you should buy it, right? They banned Google, they banned Facebook, they banned Uber. All of those were incredible investments at the time. China is banning access to Bitcoin because it offers a sort of alternative currency pathway, a tool of economic freedom, and they don't want that to exist. I don't think the US government or other mainstream Western governments are going to ban crypto. In fact, what we've seen from a regulatory perspective is efforts to try to put investor protections in place, which is good, and create a sandbox for innovation. Again, the important thing to remember about crypto is it's just a technology. It's a technology that lets us move money at the speed of internet, allows us to have digital property rights, allows us to program money like software. These are big ideas that could make our financial system much more efficient, much more open, much more inclusive. And I think regulators are recognizing that they want that innovation to take place on US shores. Banning public blockchains, which was what you would do if you banned crypto, would be like banning the internet in the early 1980s. That would have been a fatal mistake for the US economy. And I think legislators realize that it would be a fatal mistake for the US economy today. We need investor protections. We need better rules of the road. Let's do that. But I don't think you're going to see major Western governments banning crypto. They're smarter than that. I give them much more credit than that.
So a lot of articles in the media about the effect of crypto on the environment, whether something is being a proof of stake or proof of concept, and one using more electricity than the other, et cetera. Talk more about that.
Yeah. So Bitcoin was the first blockchain. And the big challenge in Bitcoin is how you have a database that's managed by 100,000 people who don't know each other and updates at the same time. The way it does that is through something called a consensus mechanism. And the Bitcoin consensus mechanism is something called proof of work, which means all these hundreds of thousands of computers have to solve these complex calculations in order to maintain this database. And it's very carbon intensive. The Bitcoin network consumes a significant portion of electricity. Now it has a nice renewable mix. It has more than 50% renewable energy. It's the highest renewable energy mix of any industry, but it absolutely consumes a lot of energy. My way of framing it though, and what I think is real, is, like many industries, crypto is moving from this carbon intensive past to a carbon neutral future, right? I still drive a gas powered car. My next car is probably going to be an electric car. The automobile industry is moving from a carbon intensive past to a carbon neutral future. In crypto land, that means changing the consensus mechanism. So instead of proof of work, using a new technology called proof of stake that reduces your carbon emissions and energy footprint by more than 99%. Most modern blockchains developed in the last few years are using proof of stake. Ethereum, which is the second largest blockchain, is moving from proof of work to proof of stake. Look, the industry is moving aggressively from a carbon intensive past to a carbon neutral future. More pressure to accelerate that, I'm all for, but it's moving faster than most other industries in the world. And so I think the environmental story long-term is going to look at crypto and smile. It's making real progress. It's going in the right direction. And I think that analogy between gas cars and electric cars is really applies here. That's what we're seeing in the industry.
Yeah. I just, as a side note, I recall reading an article where some of the crypto makers would sort of go from a high energy cost location to a low energy cost location in order to mine their Bitcoins, and they're like nomads.
That's totally right. Yeah. If you go to Iceland, a lot of the old aluminum smelters are now crypto mining areas because they have huge amounts of renewable energy, nothing to do with it. It's cold, so you can cool the computers. Absolutely, they'll search out low cost energies. Often that's either renewables, which is great. The downside is sometimes it's sort of slurry coal and leftover edge cases, which can be very carbon intensive. So those are the kind of things that we need to push for and improve, but the industry is making real significant progress.
Yeah. So I find that the world of crypto is interesting in part because we have to learn a whole new lexicon, DeFi being one of the words that we need to learn. Tell us more about what DeFi is, and will have an impact on the real world.
Yeah, absolutely. It's going to have an impact on the real world. DeFi stands for decentralized finance. The way I like to explain this is, think about going to get a loan. You go to your bank and they check your credit score and they check your income and they give you a loan or not. Now, right now, that's a very human process. You have to walk to your bank. You have to shake someone's hand. You have to fill out paperwork. It takes multiple days. But if you boil it down underneath the surface, it's just two if-then statements. If Matt has this credit score and this income, give him a loan. Otherwise, not. Anytime you can boil an action down into if-then statements, you can program it to software and execute it at no cost and instantaneously, rather than through a sclerotic process. So the idea of DeFi is, how do we use the fact that crypto makes money native to the internet to automate and make more efficient traditional financial processes? And this is not theoretical. This sounds like a Jetsons thing. It's not theoretical. I'll give you two examples. There's a DeFi protocol called Aave. It's a software program. If you have, let's say, $100 million of Bitcoin, you can use that as collateral to take out a loan on Aave instantaneously for tens of millions of dollars with the push of a button. Why? Because they can automatically seize your collateral if it drops below a certain level. There's no need for the sclerotic processes. I'll give you another example. You've probably heard of Coinbase. Coinbase is like the Charles Schwab of crypto. You can go there, you can trade Bitcoin for Ethereum. Well, there's a DeFi protocol called Uniswap. That's just a software program. No employees, no offices, no entity. It's just a software program. You can go onto Uniswap and trade Bitcoin for Ethereum, Ethereum for another crypto asset, the same way you can go with Coinbase. Last month, Uniswap did $50 billion in trading volume with no errors, no employees, no offices, no CEO. The dirty little secret of finance, there are two dirty little secrets. One is that money moves extremely slowly, right? Stocks settle in 2 days. And two is the technology is from the 1970s. People are still programming in COBOL. The idea behind DeFi is we can disrupt financial services the same way Amazon disrupted Sears. And you're seeing massive indications that this is true in Uniswap, in Aave, in Compound, in a bunch of these other protocols, which are doing what banks do, but 1,000 times faster and more efficient.
You mentioned speed. I would be remiss if I didn't mention that sometimes people have suggested that the speed of transactions relative to MasterCard and Visa is a little bit slower. Any thoughts about the state of speed?
Yeah, it's a throughput challenge. So the speed of an individual transaction can be really fast, but the speed of like doing 15,000 transactions a second on Bitcoin is not something they can do right now. It's similar if you remember the early days of the internet, you try to watch video and it would buffer, or you try to like listen to a baseball game and it would get hung up on the third inning. The throughput of the internet at that time was too little. But there were no major technological limitations to go from that to the streaming that we have today. And now it works perfectly. The same thing is true in crypto. Blockchain throughput is limited, but there's no law of physics that means it can't process transactions as fast as Visa or MasterCard. There are a couple different solutions. One is called layer 2, which is like building a highway access road. One is called sharding, where you divide the requirement to settle transactions amongst a bunch of different pieces of the network. This problem will be solved. It's exactly analogous to that early days of the internet, and people who recognized that it would be solved and built and invested for that future were rewarded. Same thing is true in crypto. It is an issue today. Don't get me wrong. Not as fast as Visa, not as much throughput as MasterCard, but there's a clear path to how that happens, and I feel confident that it will.
So another term that people have to become familiar with is NFTs, non-fungible tokens. It's a head scratcher.
Yeah, Bob, when you see a picture of a funny looking ape selling for hundreds of thousands of dollars, what do you think? You're laughing,
right? Oh my
right?
goodness, I'm laughing and thinking there's someone about to buy a bridge in Brooklyn or something.
Yeah, exactly. I do too. You know, we saw Christie's auctioned a piece of digital art for $69 million, which looked like it was done by my 13-year-old. And I laughed about that too. Here's the thing. When you see that Christie's auction, I don't know that it matters that you think it's ridiculous someone paid $69 million for this piece of digital art, right? Remember when someone paid $50,000 for a banana duct taped to a door at Art Basel, right? People do silly things with their wealth, particularly in the world of art. Here's what I thought when I saw that Christie's art auction. Why is it the first time Christie's is doing a digital art auction? There's been digital art for 4 decades. NYU has had a digital art program for years. I've been to digital art installations at major museums. Why was this the first major digital art auction? And the reason was, one thing that blockchain and crypto allows you to do is to have native digital property rights. Before blockchain and crypto, the only way to own a digital good, which is just a string of letters and numbers that anyone can copy and paste, is someone had to maintain a database that says you own this digital good. Like your bank maintains a database that says you own your bank account. Otherwise, I could copy those numbers and I would own your bank account. But a blockchain is a database that's not managed by any entity that everyone can see into. So if you record ownership on a blockchain, you can go anywhere in the world and say, I'm the rightful owner of this digital good. That's why we're now having digital art auctions. So when you hear NFT, don't think bored monkey. Think digital property rights. And the applications of that are massive. I'm going to give you 2. I know I'm going on, but NFTs are the perfect example of something that gets dismissed by many people, but actually is a massive technological breakthrough. Here's 2 other ways that's going to impact your life in the next 5 years. Today, if you're a fan of a musician, let's say you find a band before anyone else. Let's say you saw Radiohead in a Scottish pub in the 1980s, right? What you do with that is you buy the t-shirt and you tell your friends, and you get social credibility for being the cool guy who knows this band before anyone else. They're now music NFTs. What is a music NFT? A music NFT is where an artist creates a song, divides the streaming rights to that song into 100 or 1,000 pieces, and sells the streaming right to that song to their fans. So instead of selling the rights to their music to Sony, they fractionalize it into NFTs and sell it to you as a fan. So go back in time. You could have bought 1/100th of the streaming rights of Born to Run when that first came out from Bruce Springsteen. Instead of just buying the t-shirt, you can buy an economic right in the artist's success. And I think that's going to transform how all music is done. From the artist's perspective, they get a direct relationship with fans. From a fan's perspective, they're now like boosters of this artist because it actually benefits their bottom line, and they get other cool merch. That's an example of how this technology of digital property rights can do more than just be a bored monkey. I'll give you one other example. There's an article in Science Magazine a few months ago about how you can use NFTs to own your personal medical records. so that when you go to your doctor, you can actually release your medical records to that specific doctor. They can add whatever happens at that visit, and then you take it back. And when you go to another doctor who's not related to this doctor, instead of filling out 5,000 forms, you can just do a transaction to show your medical records to that doctor. It's so much more efficient than what we're doing today. Again, it works because what an NFT is digital property rights. So again, look past the monkeys, just like you look past the banana duct tape to the door. NFTs are going to be one of the biggest technological breakthroughs in terms of reshaping how the world works over the next 10 years that exist today. I think they're a really big deal.
Well, I'm going to be an avid watcher of that process, I think.
Yeah.
So when we think about how to invest, is it better to invest in crypto equities like Coinbase or crypto assets like Bitcoin and ETH and Solana and Cardano?
Yeah. I think they're both valid approaches. The analogy I would make is to buying gold versus buying gold miners. Some people like to own gold itself. It's the pure play on owning gold. Some people like to own the picks and shovels, right? Which have maybe a leveraged relationship to gold or maybe are building out around the industry. Crypto equities are a great area of the market. You're talking about Bitcoin miners, mining equipment manufacturers, brokerages like Coinbase, banks like Silvergate that serve crypto companies. If crypto as an industry grows, if blockchain grows, these companies should do well. And it's very appealing to own them to many investors because they have profits, they have losses, they have revenues, they have sales. You can do traditional valuation metrics. It's a more comfortable place to play. They're not as pure as crypto assets, but crypto assets are more complex. You can't buy a spot Bitcoin ETF. You can buy a crypto equity ETF. You can't do a P&L on Bitcoin. You can on Coinbase. So I think it's just sort of different levels of comfort for different types of investors. I own both in my personal portfolio. And for an investor who truly wants to be exposed to the full aspect of what's going on in crypto, owning both is a pretty good idea.
So you mentioned you can't do a P&L on crypto, and I recently had the pleasure of interviewing Bill Sharp, Nobel Prize winner, and we talked about crypto. And it was a head scratcher for him because he said, I can value a stock. I know its earnings. I know its revenue. I know its et cetera, et cetera. I know its balance sheet. I don't know how to value a blockchain.
Yeah, it's challenging. And it's challenging in part because different blockchains are valued in different ways. Bitcoin is really like digital gold. Bob, how do you value gold? Right? People talk about its industrial use, but really it's a store of wealth. It's based on supply and demand. Bitcoin's actually even simpler because the supply is known and fixed. They're 21 million. So it's just demand. And I think a lot of people dismiss other crypto assets because there is no fundamental valuation of gold and therefore no fundamental valuation of Bitcoin. It's just supply and demand. Other crypto assets, though, are very different. Ethereum, the second largest crypto asset, is not like Bitcoin. Ethereum you can think of as a virtual computer in the sky or a virtual database that anyone can access. And let's say I want to buy that $69 million NFT from you and you sell it to me and it's recorded on the Ethereum database. We need to make all the computers that are updating that database update their records to show that now I own that piece of art. The way we do that is we pay a fee in Ethereum to the Ethereum network, and that Ethereum gets consumed. Now, what that means is that Ethereum is more like gas going into your car, and you can actually start to do some valuation statistics. I'll give you a few points. Last year, Ethereum did $9.8 billion, I believe, of revenue. That was Ethereum fees paid into the network. It operates, you could argue, at 100% gross margins. And that revenue growth was up about 1,900% year over year. Now, you can't quite do a P&L because it's not throwing off cash flow, but it is taking an asset or a commodity and making it more scarce. And as demand for that commodity increases, you can get pretty close to a DCF. So I think someone like Bill Sharp is really looking at Bitcoin, which again is just supply and demand. There's a whole nother world of these more functional assets, which really get a lot closer towards DCF. And you can end up at reasonable valuation statistics. For what it's worth, they would suggest that Ethereum is relatively undervalued at its current price. They're not perfect. It's an emerging science, But there's more to it than what Bill Sharp was
Yeah.
saying.
So our audience is largely financial advisors, and the million-dollar question is, how do advisors incorporate crypto into their portfolios, especially in a world where you might have wirehouse brokers who have certain restrictions, or duly registered advisors over here and RIAs over here?
Yeah.
What's the best approach?
So I'll say the access points are increasing. Even if you can't add Bitcoin directly, often you can get crypto assets and crypto equities. And even at those wirehouses, you're increasingly finding ways to get exposure to crypto assets through funds like the ones Bitwise offers or our competitors offer. So that landscape is improving. From a portfolio construction perspective, though, I'll say that there are 3 rules you need to keep in mind. One is this is a long-term asset. Crypto is extremely volatile. If you're going to hold it for the next month, it could go down 50%. It could go up 50%. That's not an appropriate role in a portfolio. That's speculation. You really need to be thinking about year 2, 3-year holding periods if you're going to allocate to the space. The other 2 things, most investors are best served with an allocation below 5%. Above 5%, you start increasing the maximum drawdown of your portfolio significantly. And that's something that clients feel in their gut and can lead to bad behavioral outcomes. The average Bitwise customer has about 2.5% of their net worth in crypto. And then the third piece, which is really important, Bob, is you have to rebalance. For reasons I don't understand, people tend to treat crypto differently than they treat the rest of their portfolio. They just buy it, set it, and forget it. If you buy it, set it, and forget it, it can severely impact the sort of performance of your portfolio, because if it 10x's and you bought a 2% position, guess what? It's now 20% of your portfolio. Your portfolio is extremely volatile. What our data shows is that if you buy and rebalance, whether annually, quarterly, or on a tolerance basis, there's never been a 3-year period where adding it to a portfolio didn't boost the Sharpe ratio of your portfolio substantially. It has a 100% win rate. Even over a 2-year period, it has a 94% win rate. So again, long-term holding, rebalance, and for most investors below 5%, those are the 3 magic keys.
Yeah. So I want to talk about what kind of adoption you see among advisors. But first, I recently interviewed Logica Research, which has done studies around the future of money. And one of their findings, I'll read to you. About 1 in 7 Americans own crypto. Almost half are likely to own crypto in the next 5 years. And then more affluent Americans currently own crypto and are planning to own in the next 5 years. So obviously the investors are there. Do you see that kind of adoption among advisors yet?
It's coming. It's coming in part because the investors are there and they're asking their advisors about crypto. And if their advisors don't have good answers, they're going to other advisors for it. Yeah, Coinbase has 100 million customers, which is more than Charles Schwab, E-Trade, and TD Ameritrade combined. Crypto is a big deal. We do surveys every year of financial advisors, and the data is really telling. What our most recent survey showed is that the percentage of advisors who own crypto in their personal portfolios grew last year from 24 to almost 49%. So a massive uptick. Nearly half of advisors own crypto themselves. The percentage allocating in client accounts is going up substantially every year. It's still below 20%, but it's way above zero, right? Bitwise serves, I think it's something like 1,000 RIAs. There are a lot of people out there that are making allocation. Most advisors are still allocating for a few clients and not across their book, but that is starting to change. You're starting to see crypto enter model portfolios. So you're behind the times if you're not ready to answer questions about crypto. You're probably on par if you're helping a few clients allocate who really want exposure, and you're one step ahead of your peers if you're using crypto as a business development tool and incorporating it into various models. That's sort of the red light, green light, yellow light of where advisors are today.
So I know you won't be able to answer this in a unbiased way, but but is there a need for a certification around crypto?
Yeah, absolutely. I think certification is great. You mentioned or showed the book from Rick and DAC FP. We put all of our sales team through that certification as an example of why we think that's valuable. Look, I really do think from a business development perspective, being prepared to answer questions about crypto is going to be critical in the next 5 years. You could like it, you could hate it. But if you just ignore it, the sort of it's going to amount to nothing, those stories are getting more and more difficult to tell, right? Ray Dalio invests in crypto. Stan Druckenmiller invests in crypto. JP Morgan has a couple hundred people on its blockchain team. This is a one-way long-term trend. Sure, it's volatile, but you're not going to be able to ignore this. So something like the DAC FP certification is a great idea.
Yeah. So let's talk more about some current events. You mentioned firms adding teams like JP Morgan. Obviously, there's some cross currents. Jamie Dimon saying one thing and Elon Musk saying another. But what to me is interesting is we've just watched Fidelity say that they're going to allow people to invest in crypto in their 401k plans, contrary to the sort of the philosophy of the Labor Department, which thinks it's perhaps not prudent. Any thoughts?
Yeah. I applaud Fidelity for pushing the envelope. One of the advantages they have is that they're a family-owned firm, and so they're able to move the ball where they think it should go. And look, the world is normalizing around crypto. I find the Labor Department's reluctance to allow people to allocate to it surprising. Again, it's the best performing asset class in the world over the last 3-5 years. That doesn't mean it will be in the future. But there's a lot of data points that suggest this is a big deal. 5% of all venture capital activity last year went into the crypto market. These are the smartest investors in the world. Many of the largest institutions and endowments are allocating to crypto. It's unclear to me why it's a great idea for the largest and smartest hedge funds in the world and a bad idea for investors, as long as it's contained within the right level of exposure and designed to be held for long periods of time. There's no guarantee it will work out, but you can't dismiss it out of hand. So I applaud Fidelity. I think they're the first. They're not going to be the last. Again, I think 5 years from now, this is going to feel completely normalized in people's portfolios.
All right. So 5 years is a long time. Right now, we're looking at current market conditions. As we talk, I look down at my Coinbase account and I see that Bitcoin is trading at 20,987.15. Cardano, 49 cents. Solano, $40, all down dramatically from their highs. What's about current market conditions and where we go from here?
Yeah, volatility is part and parcel of crypto. Since Bitwise launched in 2017, I think we've gone through what would be 7 bear markets in the equity market. We went through an 84% drawdown in 2018. And despite that, crypto is up hundreds of percent. This is a normal correction to a change in the macro environment. We are currently seeing some shaking of crypto, right? The old Warren Buffett saying, you find out who's swimming naked when the tide goes out. We had this macro-driven pullback, and now we're finding out that during the bull run for crypto, some bad businesses and bad projects were launched, and those have to be cleaned out. And that can create an ugly period of volatility. And I suspect there could be continued volatility in crypto for the next 3 months. But underneath the surface, underneath that macro and then sort of ripple effect pullback, the fundamentals of crypto remain extremely strong. You mentioned the Fidelity news helping push the normalization of crypto. Some more technical factors, the number of developers working in the ecosystem is higher than ever. The amount of venture capital coming in is higher than ever. I would argue that regulatory progress is in a better place than it has been in the past. So the fundamentals remain strong and the core technology still just works. It's still the case that money is the slowest moving thing in today's society. It's still the case that our financial system is sclerotic. It's still the case that we don't have ownership of digital property rights as a mainstream thing. And crypto and blockchain solve those problems. It won't be a linear path, but when you look back at this and you look over a 5-year period, the progress over the last 5 years is hard to ignore. And it's going to be dwarfed by the progress of the next 5 years. So volatile markets, that's part of crypto. But the fundamentals remain really strong.
All right, so we covered a lot of ground. Anything we missed or anything that just bears reemphasizing?
This was pretty comprehensive. I'm impressed. I would just remind people, crypto is an interesting area of the market and a volatile area of the market. If you're going to make an allocation, size your allocation appropriately, and then think about rebalancing like you do with other assets. But don't dismiss crypto out of hand. It's a big technological advance. A lot of smart people think it's interesting. And just because it's volatile right now doesn't mean we won't be back in more interesting times in 6 or 9 months.
All right, Matt, I want to thank you for sharing your knowledge and wisdom with our listeners. It's greatly appreciated.
This has been great. Thanks for the great questions.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.